Lion Finance Group, ticker BGEO, just delivered a massive beat against Wall Street consensus for the second quarter of 2026. So here are the headline figures you need to know right now. Reported basic earnings per share came in at 14.39 Georgian Lori, which just absolutely crushed the consensus estimate of 12.97. That represents a nearly 11% beat on the bottom line.
Wow.
Yeah, and looking at the TARP line, net operating income reached 1.24 billion Lori, easily clearing the street's conservative 1.18 to 1.20 billion estimates. Forward guidance is also really aggressive. Management expects the second half of 2026 to outperform the first half, driven by seasonality, and they're targeting continued group loan growth above 20%.
Right.
Breaking that down regionally, they expect 30 to 40% loan growth in Armenia and 15 to 20% in Georgia. And the market reaction, immediate. Shares rallied 2.7% straight out of the gate to reach 12,840 pence, touching a fresh 52-week high, closing up over 1% on the day and marking a nearly 58% gain over the past year.
I mean, those headline numbers are undeniably robust.
Yeah.
But for anyone allocating capital to the Caucasus region, the actual story is really the architecture underneath those figures. A 58% rally over 12 months doesn't just happen by accident, right? And it doesn't happen on a single lucky quarter. It happens because the market is starting to price in a fundamental shift in how this bank actually operates.
Which brings us to the mission of this deep dive. We are going to unpack the segment drivers, dissect the underlying profitability metrics, and drag the macro risks out of the fine print of this Lion Finance report. Because, if you're a retail investor looking at that stock chart and wondering if you missed the boat, you need to understand exactly what is fueling this momentum.
Exactly.
And more importantly, whether the chassis can handle this kind of speed without just, flying off the road. Imagine growing your consolidated loan book by 23% on a constant currency basis in a single year in an emerging market with inflation running hot and somehow keeping your bad loans effectively at zero. That is the tension here. How did they actually pull that off?
It really comes down to the mechanics of their operating leverage. Specifically, it's how they are utilizing digital engagement to radically alter the cost of underwriting. I mean, to grow a loan book by 23% without blowing up your risk profile, you need an incredibly precise segmentation strategy. You have to know exactly who you are lending to.
Right. So let's dissect the two geographic segments driving that growth, starting with the Georgian Financial Services, or GFS. When you look at the Georgian operation, the scale of customer engagement is starting to look less like a traditional regional bank and much more like a consumer tech platform.
Yeah, completely.
Retail digital daily active users, the DAU, surpassed 1 million for the first time. That is up 20% year over year. And the kicker is that 73% of retail products are now sold digitally.
And that mechanism behind the 73% digital sales figure is what investors really need to focus on. In traditional banking, underwriting is a completely static process. A customer walks into a branch, applies for a loan, and the bank pulls a static credit score based on historical data. It's slow, it's expensive, and it looks backward. But when you have 1 million people opening your app every single day, you're building a predictive data flywheel.
So they aren't just logging in to check their balances. They're basically generating a massive, continuous behavioral footprint.
Precisely. The app is tracking how often you transfer money, when your utility bills are paid, the consistency of your salary deposits, even your merchant spending patterns. So Lion Finance is taking that real-time data and using it to price risk dynamically.
Wow.
Yeah, they can offer a pre-approved consumer loan or a mortgage at the exact moment the customer needs it, priced perfectly to that individual's risk profile. That predictive data flywheel is the specific mechanism driving their 17.1% year-over-year loan book growth in Georgia. They are entirely bypassing the friction of the traditional branch network.
Let me use an analogy to ground this.
Yep.
If we're looking at Lion Finance's broader growth strategy, the Georgian segment, GFS, is essentially a mature, highly optimized data refinery.
Yeah.
They have spent years building the digital infrastructure to extract raw customer data and refine it into highly profitable, low-risk loans. It's tuned for efficiency, cranking out reliable double-digit growth.
Right.
But then you look at the Armenian financial services segment, Ameria Bank, and that represents a completely different phase of growth. It's like a high-octane turbocharger that is generating market share gains way faster than analysts initially priced in.
The Armenian operation is fascinating because it proves the portability of that data refinery.
Hmm.
Analysts often discount bank M&A because, integrating two completely different legacy tech systems usually just destroys shareholder value.
Yeah, it's a nightmare, usually.
Exactly. But what Lion Finance is demonstrating with AmeriBank is that they aren't just buying an Armenian loan book, they are successfully exporting their entire digital software stack and sales culture into a new jurisdiction.
And, I mean, the metrics on that export are just staggering. AmeriBank's retail digital monthly active users surged 47% to over 392,000. And because they forced that digital acquisition funnel wide open, the Armenian loan book expanded a massive 36.8% year over year in constant currency.
Which is huge.
Yeah, that is moving at a velocity well ahead of the company's own internal guidance. And the result of porting that tech stack over, a 50% year-over-year profit jump for the Armenian segment alone.
Seeing a newly integrated subsidiary jump 50% in profitability in 1 year is really the ultimate proof of concept for their strategy. It tells the market that the digital leverage they built in Georgia isn't geographically constrained. They can acquire a dominant local player like AmeriBank, inject that predictive data flywheel into its operations, and just drastically accelerate its market share capture.
Right, but growing a loan book by almost 37% is easy if you are just handing out cash to anyone who asks, right? High top-line growth is only impressive if it actually translates to the bottom line without sacrificing underwriting discipline. We've all seen emerging market banks grow at 30% only to blow up 3 years later when the default cycle hits.
Oh, absolutely.
So let's look at the margins and how management is deploying this capital, because top-line vanity means nothing if your asset quality is quietly deteriorating behind the scenes.
Well, the profitability metrics in this report are elite. I mean, even by developed market standards. Overall, Q2 profit was 618.8 million lari, up 20.6% year over year. But the metric that institutional investors are really zeroing in on is the half-year return on average equity, or ROAE. It sits at 27.2%.
Let's contextualize that for a moment, because in the global banking sector, an ROAE approaching 30% is exceptionally rare. I mean, most traditional Western banks are thrilled if they can scrape together a 10 to 12% return on equity. Generating 27 cents of profit for every dollar of shareholder equity indicates massive pricing power and, frankly, severe operational efficiency.
And that operational efficiency shows up directly in the cost-to-income ratio, which improved to a very lean 24.4%. This ties right back to our discussion about the digital flywheel.
Right.
When 73% of your retail products are sold through an app, your marginal cost to acquire a new customer or originate a new loan drops to near zero. You don't have to build a new physical branch or hire 10 new loan officers to grow revenues. That is how you drive the cost-to-income ratio down to 34%.
And to address the risk of blowing up the balance sheet, the asset quality looks surprisingly durable. The ratio of non-performing loans, the NPL ratio, is sitting at just 2.1%. Furthermore, their cost of credit risk ratio is a very healthy 0.6% for the quarter.
The cost of credit risk is arguably the most critical metric in this entire earnings release. It basically represents the percentage of their loan book they are actively writing off or provisioning for expected losses. Maintaining a 0.6% cost of risk while simultaneously growing the consolidated loan book at 23% is the mathematical proof that their behavioral underwriting algorithms are actually working. They're identifying the prime borrowers in these markets and filtering out the subprime risk before the loans are ever issued.
And because they're generating this massive surplus of capital, the board is aggressively returning it to shareholders rather than just hoarding it. They approved a Q2 dividend of 3.05 lari per share, which brings the first half total to 5.90. That's a 15.7% year-over-year increase. And on top of that, they extended their share buyback and cancellation program by another 59 million lari.
A management team targeting a payout ratio of 30 to 50% of annual profits distributed through a mix of dividends and buybacks is sending a very clear signal to the market. They're demonstrating extreme confidence in the durability of these cash flows. You do not authorize buybacks and hike dividends by nearly 16% if you are worried about a hidden wave of loan defaults hitting the balance sheet next quarter.
Hold on, I actually need to stop you there and push back a little on this narrative of flawless execution. I was digging into the segment breakdown, and there is a very specific discrepancy in this report that the headline numbers are kind of masking. We need to talk about the net interest margin, or NIM.
Okay, let's hear it.
Now, at the group level, AM expanded to 6.3%. That looks great on a slide deck. And in Georgia, GFS NIM expanded by 40 basis points to 6.4%. But if you look at Armenia, AFS NM actually contracted by 50 basis points, dropping down to 6.0%. If Armenia is the high-growth accelerator of this operation, why are their margins actually shrinking? That suggests to me that they are buying all that market share at a loss, either by underpricing their loans or overpaying for deposits just to juice the volume metrics.
That is a critical observation, and it goes straight to the mechanics of how a bank funds hypergrowth. The margin compression in Armenia was not caused by a failure in the digital lending strategy or a race to the bottom on loan pricing. It was fundamentally driven by the rising cost of raw materials, in this case, regulatory capital. Specifically, Bank had to issue additional Tier 1, or AT1, capital.
Wait, let's break down the mechanics of AT1 capital for a second. These are essentially contingent convertible bonds that regulators force banks to hold to absorb potential losses, right? But because they are inherently riskier for the institutional investors buying them, they carry very high yield requirements.
Correct. When you are growing your loan book at nearly 37%, regulators require you to hold more capital to buffer against that expanded risk. You cannot just lend out every dollar of deposits you take in. So Line Finance had to go to the market and issue expensive AT1 bonds. That creates a heavy anchor on the liability side of the balance sheet. You have this sudden spike in interest expense weighing down the Armenian operation.
I see.
Yeah, and when you combine the cost of that AT1 issuance with a broader structural increase in deposit costs across the highly competitive Armenian banking sector, your overall cost of funds goes up significantly.
Okay, so they're paying a premium for the structural capital required to facilitate that growth. But why couldn't they just pass those higher funding costs onto the Armenian consumer by raising interest rates on the loans?
Because there is intense competitive pressure in Armenia right now, specifically for local currency lending. If Lion Finance tried to pass 100% of those higher AT1 costs onto the borrower, they would have instantly stalled that 36.8% growth engine. Consumers would have just walked to a competitor. So management made a strategic, calculated decision. They absorbed the higher cost of capital, accepted a 50 basis point squeeze on the net interest margin, and prioritized capturing dominant market share.
Interesting.
Meanwhile, in Georgia, they are already the dominant player. They have the pricing power to optimize their interest-earning asset mix, secure higher loan yields, and widen their margins without losing customers.
That dynamic makes a lot of sense. Georgia has the mature pricing power to widen the spread, while Armenia is actively buying long-term market share at the expense of short-term margin. But speaking of funding, I have another major red flag I want to challenge, this time on the Georgian side of the balance sheet.
Bring it on.
The report heavily promotes a massive 24.2% deposit growth in Georgia. But if you read the footnotes carefully, that number looks artificially inflated. Isn't a massive chunk of that simply the Ministry of Finance parking surplus government tax funds in the corporate center?
You are absolutely right to isolate that. The headline 24% figure is heavily skewed by those sovereign deposits. When a government entity deposits a massive block of capital at the end of a quarter, it temporarily distorts the balance sheet. To understand the actual health and stickiness of the franchise's funding base, you have to strip those government funds out entirely and look at the organic client growth.
And when we do strip out the Ministry of Finance, what does the core deposit base actually look like?
Even excluding those sovereign deposits, organic client deposit growth in Georgia was still a highly robust 18.4%.
Okay, wow. 18.4% organic deposit growth is still a massive number. It implies they're successfully capturing the day-to-day retail savings of the broader population, which brings us full circle right back to the predictive data flywheel and those 1 million daily active app users.
It is the ultimate strategic advantage in banking. Retail deposits gathered through digital checking and savings accounts are the cheapest, stickiest form of funding a bank can acquire. Consumers rarely switch their primary checking account once they are integrated into an app ecosystem.
Yeah, totally.
So that 18.4% organic growth is what allows Lion Finance to fund the aggressive expansion of the Georgian loan book internally without having to go out and issue expensive wholesale debt in the global bond markets.
So just to summarize the mechanics so far, management is returning capital confidently, the organic retail deposit growth is securing their funding base, and they are intentionally managing margin pressures in Armenia to secure market share. All of this signals deep internal optimism. But no emerging market operates in a vacuum. We need to pivot and look at the forward guidance and the specific macroeconomic risks they flagged in this report.
Right.
Because the Caucasus region is inherently complex. You are buying the geopolitical reality of the neighborhood just as much as you are buying the bank's execution.
Macro context dictates the ceiling for any emerging market bank. A brilliant management team cannot out-execute a collapsing domestic economy. But in this case, the macro tailwinds are actually accelerating.
Yeah, looking at the GDP forecasts, CEO Artul Gachechiladze highlighted exceptionally strong macroeconomic fundamentals. The bank actually revised its 2026 real GDP growth forecast for Georgia upward, moving it from 7% to a highly aggressive 7.5%. And for Armenia, despite some sluggishness in the first quarter, they expect a much stronger second half and are maintaining a 5.5% GDP growth forecast for the year.
Those are phenomenal systemic tailwinds. When you pair a highly efficient digitized banking sector with the domestic economy compounding at 7.5% real growth, the bank's operating leverage naturally explodes upward. Corporate clients are borrowing to expand, retail clients are borrowing to buy homes, and transaction volumes surge. But we do have to stress test this scenario against the headwinds they explicitly warned about.
Let's get into the friction points. First, inflation remains stubbornly elevated. It's currently running at 5.8% in Georgia and 5.1% in Armenia. And because inflation is running hot, the respective central banks are forced to keep monetary policy relatively tight. The policy rate is sitting at 8.25% in Georgia and 6.5% in Armenia.
Tight monetary policy acts as a double-edged sword for financial institutions. On one side of the ledger, elevated baseline rates allow the bank to generate significantly higher interest income on their variable rate commercial loans, which is a primary reason we saw the Georgian net interest margin expand.
Right.
However, the mechanism on the other side of the ledger is dangerous. If central banks hold rates at 8.25% for too long, the cost of servicing debt eventually chokes off household disposable income. The moment consumers have to choose between buying groceries and paying their mortgage, that pristine 0.6% cost of credit risk will rapidly start to tick upward as default cycles trigger.
But the internal monetary policy is only half the risk profile. The geopolitical vulnerabilities outlined in this report are glaring. We have the ongoing escalations in the Middle East continuously threatening to destabilize global energy prices. And much closer to home, Russia recently imposed strict import restrictions on selected Armenian agricultural products. We already saw the fallout from that ban weigh slightly on Armenia's Q2 export data.
This brings up the critical concept of structural resilience. If you are deploying capital into a bank in the Caucasus, you are inherently hyper-aware of regional instability. But we have to move beyond the headlines and evaluate these specific risks based on the actual balance sheet exposure. Both Georgia and Armenia have minimal direct economic linkage to the Middle East.
So a geopolitical escalation in the Middle East that spikes global oil prices acts as an indirect inflationary shock to the region, but it doesn't trigger a direct collapse of their primary trade routes.
Exactly. The transmission mechanism is mostly through fuel prices, not lost export markets. Now, regarding the Russian agricultural restrictions on Armenia, that is a direct, localized headwind. When Armenian farmers cannot export their produce, they cannot service their agricultural loans. But what insulates the broader Armenian economy, and by extension, Ameriabank's balance sheet, is the highly diversified nature of their external capital inflows. The economy is no longer solely reliant on exporting apples, wine, and copper to Moscow.
The report specifically points to these external flows acting as a shock absorber. In Georgia, international tourism revenues and inbound money transfers from the European Union, the United States, and Israel remain incredibly robust. And in Armenia, you have this massive structural influx of IT services and non-commercial money transfers that grew nearly 20% year over year.
The mechanics of that IT influx are vital to understand. Over the past few years, a massive wave of highly paid regional IT professionals and tech companies relocated to Armenia and Georgia.
Oh, interesting.
Yeah, these individuals are earning hard currency dollars and euros and dumping that liquidity directly into the local banking system. When a traditional sector like agriculture takes a geopolitical hit from a Russian import ban, the continued steady influx of tech capital, robust tourism spending, and diaspora remittances provides the systemic liquidity required to keep the banking sector's asset quality entirely intact. That diversified capital inflow is the specific reason the Armenian dram and the Georgian lari have maintained their strength against major global currencies despite the regional noise.
So what does this all mean for you, the retail investor trying to synthesize this earnings beat into a cohesive thesis? The takeaway here is that Lion Finance is executing a highly sophisticated dual-engine growth strategy. You have the incredibly profitable cash-generating core refinery in Georgia, and you have the rapidly scaling market share-grabbing accelerator in Armenia. Management is utilizing immense digital leverage to permanently lower their customer acquisition costs. They are maintaining strict behavioral underwriting discipline to keep default rates near zero, and they are actively returning excess capital to shareholders through dividends and buybacks, all while navigating a complex geopolitical neighborhood.
It's a masterclass in capital allocation, really. The management team knows exactly which levers to pull. They are willing to absorb the necessary expensive costs of regulatory capital like the AT1 issuance in Armenia in order to secure long-term market dominance, while simultaneously squeezing maximum margin efficiency out of their mature digital platforms in Georgia.
But before we wrap up this deep dive, I want to leave you with a broader structural concept to ponder. Something that wasn't explicitly modeled in the Q2 earnings numbers, but sits entirely behind the geography of this company's future. As global supply chains continue to fracture and pivot away from historical routes, the middle corridor, that's the Trans-Caspian International Transport Route connecting Asian manufacturing directly to European markets through the Caucasus, bypassing Russia entirely, is gaining immense strategic and logistical relevance.
The sheer volume of sovereign and institutional infrastructure investment pouring into that specific trade corridor is just staggering. We're talking about new deepwater ports, expanded rail networks, and massive logistics hubs.
Exactly. So here's the question you need to ask yourself as an investor. If Georgia and Armenia transition over the next decade into the indispensable financial, digital, and logistical hubs of this new multi-trillion-dollar global trade route, what does that mean for the long-term terminal value of the region's dominant lending institutions? If Lion Finance is already generating 27% returns on equity simply by optimizing domestic retail and consumer growth, what happens to their balance sheet when the massive institutional capital, trade finance, and corporate lending required to fuel the middle corridor starts flowing exclusively through their digital infrastructure? It is a structural shift that could literally redefine the scale of this equity.
It fundamentally changes the total addressable market. They transition from being a dominant domestic player to a critical node in global trade finance.
It really does alter the entire thesis. That is all for today's analysis. Make sure to follow the show for daily earnings coverage, structural market breakdowns, and the quick-hit financial analysis you need to keep your portfolio ahead of the market.